Hello everyone, welcome back to another video on Beyond the Mortgage. Today we're going to go over rates and more specifically the pricing that goes along with rates. We'll get into that in a second, but first of all I wanted to let you know that I got my nice nifty Snap Western shirt on today. I know there's a lot of Cowboy fans in the area. Unfortunately, they're not going to have a whole lot to watch this weekend because their team's not doing a whole lot. But I thought, well, let's include them. I'll put my Western shirt on. So Cowboy fans, I know you're upset because your teams aren't playing or your team's not playing, but I'm wearing my Western shirt to help support you guys. So you can still be involved. Now let's hop over to what I'm going to actually be talking about, which is the pricing that goes along with the rates to help determine which is the best rate for you to have. People say, well, what do you mean by pricing on the rates? Because the question I get all the time, whether I'm meeting somebody in person, on the phone, or even talking to referral partners, is like, what's the rates? What's the rates? Where are the rates going? Are they going to go down? Are they going to go up? What's happening? The rates, honestly, are always there. They're always going to go up or down, for the most part, in increments of 1/8%. What fluctuates from day to day is the price that goes along with those rates. What I mean by that is an everyday example. Think about gas. You can buy gas, for the most part, unless something's going on, you can buy gas any day of the week that you want to. You can go to Sheetz, Wawa, wherever you get your gas. You can usually pull up, get gas, no problem. What fluctuates from day to day is the price of that gas based on the market, based on how much a barrel of oil costs. Rates are kind of the same way. Think of the rates as the gas, always there, going up again or down, like I said, usually in increments of 1/8%. But what fluctuates on a day-to-day basis, especially now or recently, is the pricing that goes along with those rates based on the market. So think of this, if you really want to take a look at it, you can take a look at the 10-year Treasury yield, go to CNBC or wherever you want to hop on there for your financial news. Look at the 10-year Treasury. That is usually going to give you a pretty good indicator of what's going on with the pricing for the rates. If you see that number going up, typically not so good for pricing. You see that number going down, that's usually a good indication that hopefully the pricing will be getting better and you may be able to get a lower rate without having to pay any kind of discount points. For our example today, we're going to base all these numbers off of a loan amount of $500,000. It's about middle. We have definitely some homes in the area that the loan amounts would be higher than that, and we have some that would be lower than that. But I think that's a good average to kind of use for our example today. So again, all the numbers we're using today in this video, we're going to be basing it off of a loan amount of $500,000. Okay, so as a lender, every day we get our rates released to us, and we pull up the screen, and there's going to be columns. For us, you're going to have a rate column, a pricing column, and then your principal and interest column, which shows based on that rate, here's what your principal and interest payment would be for the loan amount you're looking at. Again, for us, today will be $500,000. Now, there's also a couple more columns. We don't need to get into those right now, but these are our most relevant ones that I want to speak to you about today to help you understand what I mean by pricing and how that impacts the rates you get and the money that you can either spend to lower the rate or keep in your pocket because paying down the rate isn't affecting your monthly payment as much to make it worth that upfront money. So let's kind of take a look at it. So as I mentioned, we have our three columns. We have our rate column that's going to show the different rates available. We have our pricing column that shows the prices that go along with those rates. And then again, the last one here is our P&I or principal and interest column showing, again, based on a $500,000 loan, this is what the principal and interest payment would be for the corresponding rate. So let's start out at 7%. Now these are just rates and pricing that I'm using for this example. I did not pull them from anywhere. Just again, to give you an idea of what I mean by the pricing. So our 7% rate, you'll see a price of 100 even. Now what that means for us is that 100 in our world, in lender world, is basically means break even. That means that as a consumer, a person looking to refinance or purchase a home, you're not paying any discount points to get that rate, nor are you getting any of a lender credit by taking that rate. If you're familiar with golf at all and the scoring that goes along with golf, you hear them say par. Well, if you're watching golf, a lot of times they say birdie, but for our purposes, we use the same terminology as golf does. This 7% rate with the 100 pricing, the break-even pricing, would be what we would call our par rate. Again, means that you're not costing anything for that rate, nor are you getting a credit. Just like a par score in golf is the break-even score. It's what you were supposed to do on that hole based on what the designer said of the course. So with a par score in golf, you're not helping your score, but you're not hurting it either. You're just kind of just going along as you should. So for our purposes, in this example, the 7% is our par rate because it's even, okay? At that 7% on a $500,000 loan, the principal and interest payment would be $3,327, okay? So if someone says, well, what if I wanted to buy the rate down? How can I do that? So, okay, well, let's take a look at it. I will tell you, most times, it isn't worth the out-of-pocket expense compared to the savings you get per month. Now, again, there are times, I'm not saying that's a blanket statement, but if you look at the numbers, many times, and I would even say most times, the out-of-pocket expense to buy a rate down will not be justified by the monthly savings. So let's take a look at that. So if we go 1/8% lower, we would be at a rate of 6.875. The price for that rate is 99.538. So a little less than par. And whenever there's a number less than 100, that means that it's costing to get that rate. Okay, so in this case, 99.538, that means that rate, 6.875, would cost somebody 0.462% to buy that rate down. And what that is you would take 500,000 times 0.462%, and that would tell you how much that rate would cost to get that rate instead of the 7% rate, which is free. Okay, and then looking over here, by getting the 6.875, it would bring your payment, your principal and interest payment, down to $3,285. So it saves you about $42 a month. Okay, we will do a video follow-up after this that will kind of go through the numbers as far as if it's worth it or not, or what is the difference in the cost compared to the monthly payment. But for now, I wanted just to talk to you about how the pricing works. So say, okay, well, that's not too bad of a cost, 0.462, not quite a half, so probably somewhere like around, $2,200, $2,300 to buy that rate down. If you wanted to go from 7% to 6.75%, so saving 1/4%, we go across, we can see the pricing for that, as we would expect, is a little more expensive. The price for that one is 99.07. So again, compared to the 100 par rate or 100 par price, that would cost either a refinancer or a buyer 0.93 to buy that rate down to 6.75, taking the payment down to $3,243. So again, based off a $500,000 loan, we're almost at a full percent to buy that rate down. So it's going to cost just about $5,000. And between the par rate, the 7% rate, and the 6.75, that's a difference of about $84. Okay, so it's going to cost about $5,000 to buy the rate down to save about $84 a month. Finally, we get down to 6.625. And one of the main reasons I wanted to show this one for my example was because it's not incremental. Okay, as you can see, from 7% to 6.875 was just under a 0.5%. From 6.875 to 6.75, about another 0.5%. But then we take one more drop down, just same thing, just 1/8% from 6.75 to 6.625. You can see it's much more than a 0.5% drop. And that's how it works. And when the pricing comes out, some days you might see your par rate and then an 8% lower could cost 0.75 point, a discount point. You know, a 0.5% lower could cost 1.5 points or discount points to get that rate. So it's not an exact, incremental increase or decrease in the pricing. There are thresholds that the investors say, okay, we're okay with this rate, but if you want to get to this rate, it's going to cost you a little bit more. Okay, so that's why, when I talk to people, I say, I always get us where we can get to without it costing anything to begin with. When I talk to people about rates, unless they specifically tell me, hey, I've got money set aside, I want to put this much money towards buying the rate down, I'm always going to start at, this is our par rate, our break-even rate that's not costing you anything, and we'll go from there. Okay, so some people might say, well, I don't understand why can't we just get 1/8% lower? Well, as you can see, sometimes just by going 1/8% from 6.75 to 6.625, it's a significant difference over, 0.74754. That's a big difference as far as cost-wise. So it's not always going to be a sliding scale. Like I said, it's not the same each time you move. And there are certain thresholds of the rates that once you get to a certain point, it really can begin to get costly to get the rate lower. Okay, so I hope that helps explain a little bit about pricing with the rates, how that works, so that when you have your next conversation with your loan officer, again, whether you're refinancing or purchasing, the question you want to ask them, and you'll blow their socks off because you're asking the right question, is, how's the pricing looking for the rates right now? Because that's going to show them that you're informed, and that's going to show them that where you have a good idea where you want to be. Okay, so I would always initially start out at that break-even rate. Okay, so you can say, hey, what's my par rate? What's my break-even rate right now based on the pricing? And then you can ask them, okay, what if I wanted to buy the rate down in 8%? What's the pricing look like for that? Okay, so we want to make sure that we're asking the right questions. And then, again, the whole goal of Beyond the Mortgage is to try to help you understand the different concepts that we deal with every day. There's no Wizard of Oz here. The more we're all informed, the better conversation we can have, and the process will go much smoother because we all kind of know what we're talking about and it makes sense to all of us. So again, this is a refresher. When we say par rate, that means it's the break-even rate. You're not paying anything for that rate, but you're not also getting any kind of a lender credit. So just for example, if I said, okay, 7.125%, what does that look like? The pricing for that might be 100.25. Okay, so that means you would get a 0.25% credit towards your closing cost by taking that slightly higher rate. And then again, it just depends on, okay, is it worth me taking a higher rate to get some of my closing costs covered? And I'll tell you an example of that. I've had, especially in this area, we have a lot of military that know, hey, I'm only going to be here for 3 years and then I'm going to get new orders, or I'm only going to be here for a year, then I'm getting moved out. So they might say, well, listen, I don't mind taking a little bit higher rate to keep more money in my pocket because the interest doesn't matter too much because I'm not going to be here that long to worry about it. So it's better for me to keep 4 or 5 grand in my pocket, pay an extra 40 or 80 bucks a month because in the next 12 months, I'm not going to recoup that upfront money with my monthly savings. So I hope that makes sense. I hope this shed a little light on what we look at when we're looking at least what I look at when I'm looking at pricing and rates for clients I work with to make sure they get the best deal all around. Not just, okay, what's the lowest rate? Because I will say I have seen some loan estimates from other companies. Honestly, not typically our local companies here. A lot of them are some of the big box companies, lenders, where they will advertise a super low rate and not tell people up front, hey, but it's costing you 8-9 grand. I had one instance where I was helping a young man, a young service member with his VA loan last year, and he had talked to, like I said, one of the big box lenders that you always hear about on TV or on the radio, and he said, well, how come their rate's like 0.25% lower than yours? I said, well, that doesn't make sense because, our pricing is pretty similar. So if you have a loan estimate, send it over. He did. And this is the first time home buyer. Unbeknownst to him, and I noticed right away, they had $10,000 and some change in discount fees to take his rate at that time only 0.25% lower from what I could offer him. It really was not worth it. It was actually, almost, in my opinion, predatory lending that they tried doing that to him, knowing that he's not seeing this. They didn't point it out to him, which they should have. But again, that's one of the things we can always look at and discuss buying the rate down. But again, it's a discussion. It should happen. It should just be, hey, here's the rate, and don't worry about the cost for it. You want to have an open conversation with your lender so that you explain to them what your goals are, and they can help you identify what's the best path for you. Is it the par rate? Is it buying the rate down? Is it maybe taking a little bit higher rate to get a lender credit? All right, so there's our video today on rates and pricing. I hope you enjoyed it. I hope it was informative. And I look forward to seeing you next time.